Good evening, ladies and gentlemen, and welcome to the Strategy of the Week for Friday, May the 10th, 2013. This is Dan Misch. I'm the Director of Retirement Services, and I'm happy to present tonight's strategy, which we're calling Easy Money Part 2, The Power of VST. On January the 18th of 2013, we first presented Easy Money, and it was a simple strategy of when to buy, what to buy, and when to sell. For when to buy, we were using the green light buyer with the RT kicker signal. And we're currently looking at a 1-year market timing graph, and I have those signals toggled on down below. So every time you see one of these green arrows pointing up was an opportunity to start buying stocks. And on the dates that those green arrows are shown, we finished with a green light in the price column of the color guard, and the 5-day moving average on the relative timing closed above the 25-day moving average on the relative timing. And you can see you had multiple points to enter the market over the year and continue to participate in a rising market. For our what to buy, we were in the searches retirement group looking at a search called high VST plus YSG stocks for Canada. And it has a few very important parameters and a sort that I want to point out to you. The first parameter is that the VST must be greater than or equal to 1. So all the stocks have a good combination of fundamentals from their RV and RS, as well as upward momentum from their relative timing. They must also have a good dividend yield, safety, and growth, as indicated by having a YSG of greater than or equal to 1. On top of that, the relative safety must also be greater than or equal to 1. And these stocks must have a 10% earnings growth rate to show up any day that you run this search. And all of the stocks that meet these parameters will then be sorted by the best combination of VST plus YSG, bringing the best stocks up to the top of the list. So we're using VST as one of the parameters for finding our stocks to buy. And in our original back test, which we ran from the 17th of 2012 through the 17th of 2013, we also used VST as our stop criteria, that if the VST of any stock we owned broke down below 1, we would sell that position. And all of the parameters for the back tests I'm showing tonight, you can click on and view by going to the Views newsletter in the Strategy section. So the original test had a gain of just shy of 25% over a 1-year time frame. It came by only spending $69 in commission, and the drawdown was a very low and manageable 5.76%. By clicking on the 5 holdings in there, 4 of the 5 stocks were bought in January of 2012, 1 was bought in June, and again, those were held all the way until the 17th, giving us the return shown here. So the first thing we did was let's update that portfolio, and we'll call it Easy Money Part 2. So what we've done is just have the same start date and bring it to Thursday, May 9th of 2013. And you can see we've now grown our $100,000 portfolio to $141,000, giving us a 41% return. It only came at a cost of an additional $20 in commission over the original test, and the drawdown remained exactly the same. So the first easy money strategy ends right here if you're looking at the watermark on the graph on the 17th. As the market has continued to rise this year, this portfolio gave you plenty of opportunity to participate in that rising market. Looking at the 5 holdings, you still have 3 positions that were bought in January of 2012, 1 from June, and then 1 purchase in January of this year. I should also point out, if we change this to a watch list view, that we can look at the dividend yields of these stocks. And since we've owned some of them for quite some time, the average dividend yield here is a little bit over 2%. So you can add that into your total gain loss as well as your annual rate of return, just making the results that much better. And since this has been working so well, giving us great returns from the stock appreciation, plus paying us those dividends, we decided to run one more test that we're calling long-term easy money. And we said, let's take this back to January of 2009. And we know the market was still falling very sharply during that time, but we wanted to start it at the beginning of the year. And all the parameters are the same. We're using high VST YSG stocks on green light buyer RT kicker signals with a stop criteria of a VST less than 1. And the reason we're using that VST less than 1 is when we get to a confirmed down situation, which would normally be the signal using the green light buyer that tells you to sell all of your stocks, we are going to take no action and keep those stocks in our portfolio and let the stop criteria manage things for us. And so you can see over this time frame of January 2009 to current, we now have a 77% total return. That only came at a cost of $189 in commission, extremely low. And our drawdown of 16% all happened in this first bad time of 2009. Other than that, you can look at this equity curve down below and see that we've had very nice, steady, rising portfolio value, giving us an annual rate of return of 17.75% over roughly the last 4.5 years. Now, when we look at these 5 holdings, we actually have 2 stocks that we bought in 2009 that are still in the portfolio. And if I scroll over a little bit to the right, you can see that they have some very large gains on them of close to 100 and over 130% return. We own 1 stock from 2010, 1 from 2011, and that one recent purchase is still in there, WestJet Airlines from 2013. By changing this to a watch list view, we can do the same analysis, and now the dividend yield is over 2, it's closer up to 3%, and so you can add that into your annual rate of return. And since this is over 4 years, that's another roughly 12% you can add to the total gain loss, bringing this up to roughly 99% return. And again, it only cost you $189 to make $77,000 on your original $100,000 portfolio. Now what I'm going to do is highlight all of the stocks we're looking at, and we're going to go look at a stock graph. And so here's the first position, symbol ENB, and I have our graph set for the same time frame as that back test, January 2009 to current. And what we're looking at on the graph is the price of the stock, as well as the VST, the YSG, the GRT, and the RS, which were those main parameters from that search. And you can see this is a great looking graph for the past 4.5 years. The VST has remained above 1 the whole time, which is why you'd still be in this stock. And on any day that you see all 4 of these indicators above their neutral line, it would have shown up for you using that high VST YSG search, showing that you have multiple opportunities to jump in on a rising stock. Looking at MRU, same story, great rising price pattern, VST stays above 1, and the core indicators are giving you multiple time frames to jump in and purchase that stock. BCE also has a great looking graph. Of course, TELUS has had a very good run, and this portfolio first purchased TELUS back here in about December of 2011. And as that VST has stayed above 1, the stock has stayed in the portfolio. And finally, WestJet, which was our most recent purchase, bought back here at the beginning of 2013, had a nice run up until its most recent pullback, and that's the only losing stock we currently have in the portfolio. Well, I think we're going to continue to test this strategy out and see what we can do to use it for our retirement services department, and we encourage you to do the same. Thank you for joining us for the Strategy of the Week.